Welcome to the Deep Dive. Today, we're really digging into the Austin real estate market. We're looking at the very latest data, fresh as of July 17th, 2025.
That's right.
You've given us this, well, incredibly detailed report, and our mission really is to pull out the key insights, the things you absolutely need to know so you walk away feeling truly up to speed.
Indeed. And it's a fascinating snapshot, honestly. It shows where things stand right now in Austin. We'll be looking at, everything from inventory levels and mortgage rates to how buyers and sellers are feeling, and even, what it all means if you're thinking about investing. What's really interesting is how all these different sort of threads weave together. It paints a pretty clear picture when you see it all laid out.
Okay, let's get into it then. You're here for those essential takeaways, those aha moments, without getting lost in all the spreadsheets and jargon. Consider this your shortcut to understanding the real pulse of the Austin housing market right now. So let's start with the basics. Supply. What's the story with just the sheer number of homes available? The report kicks off highlighting a pretty big climb in active listings.
That's definitely the place to start, yeah. Active residential listings across the Austin area, MLS, that's the main database agents use, they've jumped 10.2% compared to last year.
Okay.
We went from about 16,100 listings in 2024 to nearly 17,800 now in 2025.
Wow.
And this increase, this surge in homes for sale, has directly pushed up what we call months of inventory. It went from 5.49 months to 6.1 months. That's an 11.1% increase right there.
So explain that for us, that months of inventory number. What does it actually mean in practical terms?
It's a really crucial metric. Basically, it tells you how long it would take to sell every single home currently listed if no new homes came on the market based on the current sales pace.
Right.
Historically, if that number is under 5 months, it usually means it's a seller's market. Lots of competition, things move fast. If it's between 5 and 7 months, that suggests a more balanced market. Neither side really has a huge advantage.
Okay.
And then over 7 months typically points towards a buyer's market. More choice, maybe more room to negotiate for buyers.
And Austin is where on that scale now?
Right now, the whole Austin area MLS is sitting at 6.11 months. And if you look just at the city of Austin itself, it's even higher at 6.75 months. So this clearly shows the market has, shifted. It's expanded supply relative to demand. It's leaning much more towards balance, maybe even tilting a bit towards buyers, especially compared to how things were just a couple years ago.
That sounds like the market is finally, maybe, taking a breath. The report uses the phrase 1.1x expansion in supply relative to demand. That sounds like good news for buyers. More options, maybe less pressure.
Absolutely. More choice, less of that frantic feeling we saw before.
So with more homes out there, the next big question is cost. What about mortgage rates? They're always a huge factor. Are they still, hanging around those high levels?
They really are a persistent piece of the puzzle. So as of mid-July 2025, the U.S. average for a 30-year fixed-rate mortgage is 6.77%. For Austin specifically, the July average is just slightly lower, 6.72%. Now, that is down about 1.9% from July last year.
Right, a little bit of relief.
But, and this is a key thing, it's still 27.7% above the historical average for July. So perspective is important here.
Definitely. So slightly better than last year, but still significantly more expensive to borrow than it used to be, historically speaking.
Yeah.
How is this mix more homes but still high rates actually affecting prices? Are people paying less?
Yes, the impact is pretty clear in the numbers. The average sold price across the Austin area in July 2025 was $597,935. The median sold price, which is often a better indicator, was $450,000.
Okay, $450K median.
And here's where it gets interesting if you look back a bit. That median price is actually down $100,000, a full $100,000 from its peak.
$100,000. Wow. When was the peak?
That peak was $550,000 back in May of 2022. So we've seen an 18.18% drop from that high point.
An 18% drop in just over 3 years. That's a really significant adjustment. Does the report suggest this trend might continue? Is there more correction expected?
It does actually project that. Based on the analysis in the report, it seems reasonable to expect maybe another 10% correction.
Another 10%.
Roughly, yeah. Or about another $45,000 off that median price. And this leads to an interesting point the report makes about definitions. Are we seeing a pullback, a correction, or a crash?
Right. Those words get thrown around a lot.
They do, and according to the report's definitions, a market correction is typically defined as a 10% to 20% drop, usually happening over 1 to 2 years, with the recovery taking maybe 2 to 4 years.
Okay.
Given that Austin's seen an 18.18% drop from its peak, it fits pretty neatly into that correction category.
That framing is really helpful. And the report puts this current correction into historical context too, right? Comparing it to past downturns.
Exactly. It compares the price drawdown now to what happened starting in 2007 and 2008. So 38 months into this current cycle, we're down 18.18%.
Oh.
If you looked 38 months into the downturn that started around 2007, prices were only down about 2.3%. So this is steeper than that one.
More significant this time around compared to '07.
Yes. But compare it to the 2008 correction. After 35 months into that one, prices were down over 23%.
Okay, so not as severe as the '08 crash then.
Precisely. It gives you some perspective. Significant, yes, but we've seen worse historically.
All right, let's shift from the hard numbers to the psychology of the market. How are buyers and sellers actually feeling? The report uses the Fannie Mae Home Purchase Sentiment Index, right?
It does. And for June 2025, the numbers are quite interesting. 60% of people surveyed said it was a good time to sell.
60%. That seems pretty optimistic given the price drops.
It is, yeah. Only 39% said it was a bad time to sell. So sellers, or maybe homeowners thinking about selling, still feel relatively positive.
But what about their expectations for the future? Do they think prices or rates are going to keep falling?
That's where the sentiment gets a bit more, let's say, mixed. In that same June survey, 22% of people thought home prices would go down in the next year.
Okay, about 1 in 5.
And 29% thought mortgage rates would go down.
So almost a third expecting lower rates.
Right. It means a pretty significant chunk of people are still bracing for more changes, which definitely influences their behavior, whether they buy or sell or wait.
So if a fair number of people still think prices or rates might drop further, does that mean fewer people are actively out there looking right now? What's the actual foot traffic like?
That's a great question. And the data on traffic of prospective buyers is, well, pretty stark. It's an index number. And historically, a busy market might be in the 40s or 50s. As of June 2025, that index number is down to just 21.
21? That sounds really low.
It is. It's a 25% drop compared to last year, and it's almost 44% below the historical average for buyer traffic. It points to a very clear slowdown in active house hunting. Fewer people are out there kicking tires.
Okay, let's connect the dots. If there's way less buyer traffic, does that mean sellers are having to compromise more on price? Are more homes selling below the asking price?
That's exactly what we're seeing. The data shows that 68.5% of homes sold recently went for under the list price.
Well, over 2/3.
Yeah. And that's quite a bit higher than the historical average, which is around 61%.
Right.
And on the flip side, only 12.7% of homes sold for over the list price. Historically, that number is usually closer to 21%.
So fewer bidding wars, more negotiation.
Definitely. It clearly shows that negotiation power has shifted towards buyers. And related to this, we're also seeing a slight uptick in distressed properties. The report flags 84 active listings as real estate owned, or REO.
Which means they're bank-owned post-foreclosure.
Correct. It's not a huge number in the grand scheme of things, but it's another indicator of stress in the market.
Okay, we've hit the big headlines. Inventory, prices, rates, sentiment. Now, let's go a layer deeper. The report has a whole bunch of other metrics, these sort of market health indicators.
It does, yeah. These indices give you a more nuanced view of the underlying dynamics. For example, the absorption rate.
Absorption rate, what's that measure?
It basically measures how quickly the active inventory is being absorbed or sold. It looks at the percentage of active listings that sell within a given month.
Okay.
Right now, for the whole Austin area, it's about 17%. In the city of Austin, it's even lower, just under 13%.
And how does that compare historically?
The historical average is almost 32%.
Wow, so it's roughly half the normal rate.
Pretty much. It tells you inventory just isn't moving nearly as fast as it used to. Properties are sitting significantly longer.
Makes sense with the higher inventory numbers. What about things like the activity index or this demand momentum index? What light do they shed?
The activity index looks at pending sales relative to total inventory plus pending sales. It's another gauge of market speed. It's currently around 18.9% for the area, again, way below the historical average of about 29.4%. So another sign of a slower market, weaker demand.
The demand momentum index, or DMI.
Right, the DMI. This one compares the rate of demand growth to supply growth. It's currently negative for both the Austin area, negative 13.59%, and the city, negative 9.28%.
Negative DMI, what does that tell us specifically? Is that bad?
It basically means supply is growing faster than demand. Or, put another way, more houses are being listed than are being bought or going under contract.
Right.
Generally, that's considered a bearish signal for sellers. Market conditions aren't really in their favor. It's more favorable for buyers.
Right.
The report classifies these current DMI numbers as being in the neutral to slight bearish momentum range. So balanced, but definitely tilting towards buyers. And other scores in the report, like the weighted market health score and the balanced market health score, they're both below average too, further pointing towards a buyer's market, or at least a buyer-leaning balance.
This is really painting a consistent picture across different metrics. Now, thinking about our listener who might be interested in the investment side of things, the report dives into the 1% rule and cap rates. What's the takeaway there for potential Austin real estate investors right now?
Yeah, this is a really crucial section for investors. The 1% rule is, a quick back-of-the-napkin test. Does the monthly rent cover the monthly housing payment? PITI. Principal, interest, taxes, insurance. Ideally, the rent should be at least 1% of the purchase price.
Okay, a simple rule of thumb.
Exactly. But the report runs the actual PITI numbers based on current prices, a 20% down payment, typical property taxes, insurance, and the results are, well, pretty sobering for investors.
How so? Can you give us an example?
Sure. Let's take that zip code 7873 again. Median sold price, $1.4 million.
Right.
Median lease price, only about $2,200 a month.
Okay.
But the estimated monthly PITI on that $1.4 million house, even with 20% down, is almost $8,900.
Whoa, $2,200 in rent versus nearly $8,900 in costs.
Exactly. That leaves a monthly shortfall, a negative cash flow of almost $6,900 per month.
Ouch, that's a huge gap to cover out of pocket every single month.
It is. And this isn't just one zip code. Across many parts of Austin, the typical rent you can get just doesn't come anywhere close to covering the ownership costs right now, especially with current prices and rates. It really forces investors to ask, okay, what's my strategy here beyond just rental income? Because the cash flow isn't there in many cases.
That fundamentally changes the investment calculation, doesn't it?
Yeah.
What about the cap rate analysis? Does that offer any better news?
Not really, unfortunately. The capitalization rate, or cap rate, is essentially the expected annual return on the property based on its income. For the Austin area, it's currently calculated at 3.34%.
3.34%. Is that good or bad?
Well, compared to something very low risk, like a 6-month U.S. Treasury bill, right now that's yielding about 4.32%.
Ah, okay. So the T-bill yield is higher than the property cap rate.
Exactly. You have a negative spread.
Mm-hmm.
You can currently get a better return with virtually zero risk from a T-bill than the average Austin investment property's expected income return. And historically, this Austin cap rate is also about 27.5% below its own average for July. So from a pure investment return perspective, based on income, it suggests Austin real estate is quite challenged right now compared to other safer options.
So let's try and pull all this together. For you, our listener, whether you're thinking about buying, selling, or maybe investing in Austin,
Yeah.
what's the essential takeaway? We've definitely seen inventory expand significantly.
Yeah, a lot more choice out there.
The market feels like it's shifted power towards buyers.
Definitely. Negotiation leverage has changed.
And those mortgage rates, while slightly off their peak, are still a major factor, hitting affordability and those traditional investment models.
Absolutely. We've seen a clear market correction. Prices are down considerably from that 2022 peak. Seller sentiment is surprisingly holding up, but the actual data on buyer traffic, absorption rates, demand momentum, it all points to a much cooler, more cautious market environment.
So here's maybe a final thought to leave you with, considering all these dynamics. The increased supply, the sticky mortgage rates, the shift in buyer power. What kind of impact do you think this might have on how long homes actually sit on the market, the days on market, over, say, the next 6 months? And could these trends start to shift the balance between buyers choosing new construction versus existing homes? That interplay could be fascinating to watch. Definitely something to keep an eye on. Thanks for joining us for this deep dive.
My pleasure. It's a dynamic market, always something new to learn and analyze.